Welcome to Dollars and Cents, Creating Your Fulfilled Life with Nicole Romito from Private Vista. In this podcast, we draw from years of experience as well as guest specialists to help you create the life you imagine. Join us in this journey as we enlighten and empower you to align your lifestyle to help you achieve your goals with a clear picture of your future. Now, let's get to the show.
Hello, and welcome to the Dollars and Cents podcast with your host, Nicole Romito. Nicole, it is, I don't know, it feels like it's been forever since we've talked. How have you been?
I've been great. Just living my best life, enjoying our short summer in Chicago, but we've been very blessed this year and are still having gorgeous weather. So I'm out there trying to enjoy every minute of the sunshine.
Yeah, I know how you feel because autumn is coming to the Northeast as well. A bit of a relief from the heat, and it is nice to see the leaves starting.
I know it's so pretty in your part of the country this time of year.
It's coming. I'm telling you right now, Nicole, fall is coming. What's on the plate today?
So we have a timely topic, if you will, and we're about a month away from the U.S. elections, and people tend to want to make changes to their portfolios in anticipation of as we get more and more polls and predictions and all that. And that's why I've asked Jeremy Bell, who is the Chief Investment Officer for Conway Investment Research, to join me in studio today. Our conversation is going to discuss a few of the burning questioners our listeners most likely have. Do I change my portfolio before the election? Do the markets do better under one party or for the other? Are there any parts of the market to avoid or look into? So those are just a few of the hot topics that I know Jeremy and I are going to chat about today. So I'd like to welcome in Jeremy. Thanks for joining me today.
Yeah, thank you so much for having me, Nicole.
Absolutely. I know it's going to be a lively conversation. So before we kind of get to what I just talked about, I want to give our listeners a little bio or background on Jeremy. As I mentioned, in studio is Jeremy Bell. He's a principal and the Chief Investment Officer for Conway Investment Research, LLC. He joined the firm back in 2011 and chairs their investment committee, which establishes the firm's investment philosophy and process and ultimately oversees the implementation of recommendations that are made to their clients. In addition to leading their research efforts, his primary responsibilities include capital markets research, asset allocation modeling, alternative investment manager due diligence, and the management of key client relationships. Jeremy, when you are not, certainly that is a full-time job and then some, especially in today's environment. When you're not helping out Private Vista and other clients, what do you like to do in your free time?
Great question. Spend a lot of time with family. Got two kids, 13 and almost 10 years old. So they're very active sports-wise. And
that'll take up a lot of time right there.
Yep. So my wife, Carrie, and I, we, actively involved in everything that they're doing and, traveling various parts of the Midwest, watching them play either, soccer, baseball, basketball, those types of things. Otherwise, we like to travel, obviously spend a lot of time with family and friends as well.
It sounds delightful. It also sounds like that is a full-time travel schedule just around the kids' activities based on the sports you just shared.
Yep. Very much so. It's a little tiring at times.
Well, I bet. And I also know from friends and clients that living here in the Midwest, it's not, generally speaking, you're not traveling to maybe super exotic places where you want to tag on a few extra days.
Yep, you are correct about that. So.
All right. Well, great. Well, I appreciate you taking time out of your busy schedule to join us today and share a little bit. What I know I'll share with our listeners will be just a small snippet of your knowledge and experience since you've been doing this for a while. As I mentioned, we are going to talk about, I can't believe it. I think we're about 5-6 weeks away from the election here in the United States. This has been a very unusual election cycle from the start. We had both candidates were known very early in the process. Both have been presidents already. And then, with the most recent turn of events with President Biden stepping down as the Democratic nominee, what are your thoughts on how the remainder of this cycle plays out? Any thoughts on, what we might be seeing post November 5th? Understanding that, these are just thoughts, and certainly just as it's been a very fluid cycle to this part, my gut says, we'll continue to be in that type of environment. So we're just talking about kind of a point in time or today.
Yeah, no, great question. I think we would expect to see continued volatility, thinking specifically about financial markets. Volatility has certainly picked up over the last couple of months as, there is that added uncertainty over the election and removal of Biden from the ticket, replaced by Harris on the ticket. So as we look at 5 to 6 weeks out, the polls, the betting odds, all that type of stuff seem like they're very fluid and changing every day based on new data that comes out. But I mean, ultimately, until that uncertainty is sort of removed from markets, which, it looks like how close everything appears to be at the moment, that, we might be looking at, not maybe knowing the results of the election on election night, maybe carrying several days, possibly weeks past that in terms of some of these real crucial battleground states and ultimately, sort of their impact on, who wins the election.
Yeah, absolutely. I think that is the first key point to highlight for our listeners is, even though we will, the last chance to vote is election day on November 5th, it would be, I think it's like you said, it's anticipated. We're not going to know the results, certainly not the next morning, but perhaps maybe not even a few weeks out. So we probably will continue to see some volatility even post election day.
Yeah.
Any thoughts on, as we look at that, volatility? I think maybe I'm going to, just summarize is I think many people think of that. Perhaps they look at it as the negative side, right? I mean, I don't have a client or I don't know a person who really enjoys or likes downward volatility on their investments or portfolio. I think you and I and our associates may look at it like, hey, instead of that being a potential vulnerability, there also could be some opportunities hidden in there as well.
Yeah, I think we would agree with that. I mean, volatility obviously can be both downside and upside. To your point, most people associate it more on the negative side of things and a particular drawdown in a portfolio. But I mean, we always look at things as, any sort of corrections markets may make, as long as you understand why markets are correcting or what a particular issue may be associated with, like an individual stock or a fund that you're pursuing. The volatility could certainly present a opportunity to add additional funds to a stock fund, hedge fund, whatever the investment, choice might be out there. But, not all volatility is bad. And I think in particular, there's a little bit of an elevated feelings around it since we're coming off of a period of, really post-financial crisis when rates were at 0% for more than a decade, that, volatility within markets was extremely low, relative to history. And, at times I think people within the investment community it takes this type of volatility to give you a reminder that stocks just don't always go up in a straight line every year.
Up and to the right, right? Yeah.
Yeah. I mean, normally, I think historically over the last 100 years, you've had as many as a correction being, 5%. Corrections in the market typically happen on average 3 times per year. A 10% correction, I think, occurs about every 13 months or so. I think if you go back, look at calendar years, the average drawdown in a particular calendar year, I think over time has been about 14%. But again, if you look at those charts, generally staying invested and riding out those negative periods ultimately is meant over the long term, continuing to make money in the compounding of wealth over time. The crucial point being staying invested and not getting spooked by volatility is really the most important thing out there. So making sure that you have a strategic investment plan in place and you adhere to it, regardless of the market environment, I think is what's going to be most important for investors to take away from anything election related.
Yeah, we're certainly very aligned in our investment values and philosophy. And, while short-term volatility, again, as we talked about, yes, there's potential vulnerabilities, but there's also opportunities. But really, I think, investors get tested if they're in the right strategy when you do have periods of high volatility, both up and down. And then certainly if we go through what is a part of being an investor, you have to know that part of that normal cycle is there are pullbacks or even bear markets. And that's just part of the norm of being an investor. So you really want to make sure that your strategy that you have is one that you can stick with through thick and thin, and that you're evaluating it over a full market cycle, not just any one point in time.
Yeah. So we would agree 100% with that statement.
Yeah, exactly. And so I think too, one of the things, and since we only do audio, we don't have, we can't share. There's really a lot of great charts I know your firm has put together on showing, if you invested $1 or $1,000 at certain points of time, did the markets do better over, one party having full control of all the executive branches? Is it better with a mixed bag? Is it better with a divided government? I know we can't show any of those charts. I would say if our listeners are interested in seeing them, you can reach out to Private Vista. There's a few that we can share if you're interested. Jeremy, do you want to maybe just globally speak to those comments, if you will, knowing that we're not, I guess I should have said this in the opening as well, is, Jeremy and I are we are not endorsing either candidate or party. So anytime we do talk about that is more just as from a historical or data perspective. But are you able to speak to that even though we're only audio? What are your thoughts on that?
Yeah, no, I mean, obviously there's a lot of great historical data out there, and you can assess the different presidential cycles, the different congressional cycles, all those types of things. I think the main takeaway from it is over really long periods of time, it doesn't really matter who occupies the White House. I think the best scenarios on a calendar year or over a 4-year presidential cycle tend to be markets like divided government. If you've got, whether it's a Democrat or a Republican as the president, typically they want to see, some sort of divided government in place, because ultimately I think that means you're not going to get, or you're going to be looking at more in the way of compromise. You're going to be looking at, less extreme policy making under a scenario where maybe Republicans held all houses, or held the presidency, the Senate, and the House together, or vice versa, the Democrats holding the House and Senate and the presidency. You just tend to probably get a little bit more partisan types of politics that maybe don't favor the entire country as a whole. But that being said, again, the overarching takeaway has been remain invested over all parties, all congressional cycles, et cetera, just because at the end of the day, markets tend to perform well over long periods of time. And I think one other, important thing to always look at, I mean, again, you can look at George Bush, or George H.W. Bush is a good example. His market returns were generally pretty negative, and is a sort of an outlier out there because he had four-year cycles where the market returns were negative for, say, the S&P 500. A takeaway from that is you also need to look very hard at what were the surrounding extraneous circumstances that contributed to that. So one is obviously the tech bubble, which, he was president from, call it roughly 2000 to 2008. You had the tech bubble burst in the early 2000s. Then his second term was really hit hard by the global financial crisis. So again, two situations where there were very extraneous circumstances that impacted any policies that would have been put in place by his administration that's out there. Both, I think a lot of presidents, whether we're looking at the Trump or the Biden administration, they both posted very strong market returns, very different types of policies that are in place. You did have Republicans controlling everything for, the beginning of Trump's term. I think he had, Democrats largely in control under Biden. But, again, I think its performance has been particularly good under either regime. And ultimately, we think it's very important that you're looking at all these different circumstances, like what's the Fed doing? What is the geopolitical situation? Right now, you have, markets are largely ignoring, two pretty significant wars that are out there, but you've had a rising rate environment. You've had a bunch of different sort of circumstances out there that ultimately we think are more important to what dictates market returns than who occupies the White House or who really controls Congress.
Yeah, those are great points. And I know one I wanted to highlight, and I think part of it is media driven, is they're speaking about like who's going to be president, but the president, the way it's set up, right, there are those checks and balances. So it is important to see who also is going to either gain or maintain control of the Senate and then of the House. So that's key. And then I think the other thing you wrapped up with that maybe we can dive a little deeper is while it will have some impact over, as we just talked about, president and then the House and Senate, is also though the people who are controlling kind of the financial markets, right? So we just had, and since we're talking point in time, we can reference specific events or dates. The Fed just, as expected, reduced rates. What maybe wasn't as expected is they kind of came out on the bigger end and did a 0.5 point reduction within the last week or so. Do you want to talk about, I know you said like, instead of focusing on just that it's an election year, what are we thinking, or how can we maybe look at, or things to consider about, monetary policy, what the Fed's doing, and then certainly too, just how foreign relations possibly could play into, I guess, portfolio construction, if you will, knowing that we're talking, again, very high level and no specifics.
Yeah, I mean, obviously the Fed last week cut rates by what was probably on the higher end of things, 50 basis point cut. So they've actually started their easing cycle after,
right,
a very significant and quick increase in rates to combat inflation that reached as high as 9.1%. So now that inflation has come back more to depending on the gauge you're looking at, sort of mid twos to around 3%. Again, PCE versus CPI inflation numbers differ a little bit based on the substitution of products that can be included. But, inflation has come down, but at the end of the day, now they have a dual mandate, which is also to look at the unemployment picture. Unemployment has gone from about the mid threes to, I think, 4.2, 4.3% for the last number. A lot of downward revisions that we've seen. So they've shifted their focus from the fight against inflation to probably highlighting that the bigger risk today is rising unemployment. But Chair Powell kept referencing more of a recalibration of monetary policy, mainly thinking that, the economy is doing pretty well. I mean, if you look at the latest numbers out of the Atlanta Fed, they keep a GDP now, which is based on all the incoming data. Q3 growth is still expected to be pretty strong in the upper 2% range, almost 3% growth, which is, certainly above trend levels. Again, inflation has come down, but we generally think there's a lot of mixed data out there. I mean, if you look at things like the PMIs, retail sales, durable goods, consumer spending, I mean, those trends have really been all over the place. So, we think the economy is on, still solid footing, but, there are some concerning trends with consumers, which drive ultimately about 70% of the U.S. economy today. So, they have started to ease policy. I think there's, an additional 2 to 3 rate cuts, at least according to the market, that are baked in for this year. along with, several additional rate cuts expected in 2025. Ultimately, the market is expecting the Fed funds rate to drop. We were at 5.25% to 5.5%. The expectation is to be near about 3% by the end of 2025. So, I mean, that's significant easing, which should ultimately, help the housing market, help auto loans, help credit card rates, all those types of, interest sensitive rate areas of the economy should at least see some less restrictive sort of policy that's out there. So, that to us could be more important than any policies that come out of either, Trump or Harris in the future. But, we do think it's something to keep an eye on. I mean, again, I think the other big issue that's out there seems to be, whether it's the war in the Middle East, Ukraine, Russia, but
Right.
it seems like the markets have been very complacent to all of that activity right now.
Yeah, they really have, which has been a little surprising.
Yeah, I think everything, at least for now, seems to be contained. I mean, Ukraine and Russia seem to be a sort of a stalemate that's out there. And,
Yep.
I think depending on which side of the political spectrum you're on, you probably see maybe two different outcomes of should they be at war, or how can we solve this problem, that type of thing. The war in the Middle East, seems like there has been, some increased flare-ups over the last week. And, that's concerning. But right now, I think all eyes are on whether, the U.S. and other parties can sort of contain this to not be a full-blown, regional conflict. And to date, it seems like they've accomplished that, but it's a very fluid situation right now. But, again,
Yes.
our markets are largely ignoring that. I think, some very powerful themes are in place here. And I think, again, people are more focused on just the economy seems to be in solid shape. And if you look really the comments about the U.S. that Biden makes routinely about the U.S. really being in far better shape than the rest of the world, I think we would, echo that, and our asset allocation modeling sort of points in that same direction, that we really do favor the U.S. from a macro and a micro standpoint. And, ultimately earnings and economic growth should be the bigger driver of financial markets here in the U.S. than what's going on in terms of an overseas war.
Yeah, I agree with you. Is there what maybe themes or I'll stick with themes. What themes are you and your team watching to see, like you said, that generally the economy's certainly in better shape than other economies of the world? With interest rates going down, as you mentioned, that certainly starts to give a little relief for those, certainly on the credit card side, since that'll adjust immediately. Could also help with maybe some of the small businesses if they have variable lending. So we're getting a little bit of easing on that. What are you and your team watching to see if, like, okay, that the economy still is on, solid footing, or what might occur where you're saying it's starting to deteriorate a little more?
I think we continue to look at all the incoming economic data points that are out there. We look hard at the PMIs. They're a little bit more forward looking in terms of, what's sentiment around orders and exports and things of that nature. But, looking a lot at sort of the retail sales trends and credit card delinquencies, which have been really on the rise lately.
Right.
Durable goods. Some of these things more for business purposes. Unemployment is clearly a big one that's out there. But all in all, I think we think that the economy's in pretty solid footing right now. And we think that the Fed is thus far, we think they missed it pretty big on the way up in terms of tightening policy, but I think we were encouraged that they went a little bigger than expected with 50 basis points. Maybe that's to try and get ahead of the game.
Sure.
But, all this data, I think they pointed to the fact that they are really going to be data dependent. And I think with all the data being a mixed bag right now, I think you just need to continue focusing on, making sure that you're adhering to your long-term strategic asset allocation, your long-term goals, you're appropriately, sized from a risk perspective, and picking a lot of what we do here at Conway is obviously manager due diligence. So at the end of the day, making sure that you're invested with the highest quality funds and alternatives and all those types of things, in place to, be able to build a diversified portfolio that can weather any sort of market environment that's out there.
Yeah, I agree. And just to add on to that, I do think that I agree with you that we're going to continue to see volatility, certainly up until the election date. And then I know, at least historically, it's not unusual to have it for maybe 4 to 6 months after that. As just trying to figure out how are things going to kind of pan out, and what campaign promises may have a better chance than others of actually getting enacted.
Hey, pardon the interruption. I know you are listening to Dollars and Cents, Creating Your Fulfilled Life with Nicole Romito, and we're happy you're here. If you have any questions, please head over to myprivatevista.com or the show notes to find out how to reach us. We'd love to hear from you.
So with that, why don't, and I agree with you, and at Private Vista, we certainly are taking a long-term approach to both, asset allocation and helping our clients when they are investing, understanding that it's over a longer term time period that we're going to want to be deploying those funds. You've shared a lot of great, I would say, wisdom, and certainly some from your experience from prior election years that we've been through. Do you have maybe like one or two either key takeaways, either something maybe you wanted to make sure to share, or if you really wanted to highlight one or two of your prior comments as kind of the key things for our listeners to take away today?
Yeah, I think a couple that I would point to, I think history generally favors positive S&P 500 or financial market returns, regardless of the presidential outcome. And I think regardless of the political party that's in power, tends to provide very little insight into, future stock market returns, just because of all those external forces which can impact what markets are doing at any given time. We often speak of, what's going to be the next significant drawdown crisis that occurs. It's probably something none of us on this call are thinking about. We don't know where it's going to come from. That could impact a president at the wrong time. We don't know where you're going to have another financial crisis, hopefully never, but there's all these external forces out there, which, I think can ultimately override any sort of tax policy or regulations, things of that nature. But the big takeaway, again, investors, make sure to have your long-term strategic plan in place. We think trying to be very tactical around trying to predict an election outcome to us is very, very challenging, because at the end of the day, you need to make two decisions, which I would highlight. One, we often get a question, if XYZ is going to win, I'm going to pull my money from the market because I just don't like the policies. Okay, so you might get the decision to remove your money from the market, but that's one decision, which you may get that one right. But at the end of the day, you need to then make a second decision, when am I going to get back into the market? Most people might make one decision properly. I'm not sure I've ever met anybody that can make both right. If you time that poorly and you don't enter the market at the appropriate time, you could be missing out on some substantial gains, because again, over a long period of time, I don't really see that either one of these presidential candidates is going to be able to enact any significant sort of policies in terms of major, policies, what that favor one way or the other. So, the best bet is really just to, again, adhere to that long-term strategic plan over long periods of time. It's not going to matter who holds office, who's in control of Congress, especially in, sort of this day and age where very little seems to get done outside of executive order within markets today. So until something dramatically changes on that front, we think it just makes sense to sort of stay the course, remain calm throughout the election process, and make sure that your portfolio has enough diversification and enough diversifiers and unique strategies and return streams that, when one thing's out of favor, hopefully you have two others that are doing well. That's the whole point of, why you have things like fixed income in there, or potentially alternatives that, again, can be great diversifiers for a portfolio and provide that protection during higher volatility periods.
Yep. We at Private Vista, we couldn't agree more. It really just, you got to kind of keep your eye on that longer term perspective, and really just got to think about your portfolio to support your personal goals and what you're trying to do for you and your loved ones. And that's going to be different for each one of us depending on our situation. So I would say, I know, I don't think you and I would be having, if we had a YouTube channel or something, we probably wouldn't have a lot of subscribers, since that isn't it's not exciting and it's not sexy, but we've both been doing this long enough to know that it is a sound approach when you're trying to manage your money.
Yep. Yeah.
So,
one other thing I would stress
yeah.
too is, it's amazing how fast markets move too. So trying to time anything today we think is near impossible. So again, why you should have elements of growth and value and large and small and US, non-US. Just to us, it's impossible to time anything, even if you want to be tactical, because it's just, we think, near impossible.
Yeah, no, that's a good point. We certainly have had a few of those. We've had a few examples of that in the past month or so as well. So
Yep.
By the time it even happened or came out and you were like, oh, here's what I'm going to do, it either had fixed itself or was going in a completely different direction.
Yep.
So, okay. Well, thank you so much for sharing your time and what I know is a small slice of your wisdom and experience. Appreciate you being here with me today.
Thank you so much.
Yeah. And then I think, as you know, I ask all of my guests, if you could live, if no time constraints, no school district constraints or sports schedules and things like that, where would you most like to live and why?
I think as I've gotten older, I think I've become more of a warm weather place. So the cold, I can't deal with it anymore. I don't know, a place that's gotten a big piece of my heart. I would say, Cayman Islands, I like quite a bit. There's
nice.
a lot of activity financially down there, but then I don't know, consider it one of those places to live where most people go to vacation. So seemed like a pretty good spot, warm all year round, and again, sort of a British colony, so fairly Americanized. That just seemed like a place I could see myself being for a long period of time.
Sounds great. I will add it to my list. I have quite the list of places I'm going to be able to visit.
Yeah. One of my favorite parts about doing this podcast, Nicole, is that every podcast I end up with a different place to move to when I decide to retire.
Exactly.
One of the things that's interesting, it's good because it bears repeating, Jeremy, is that your note about emotion versus discipline. The irony there is, of course, is that when one is emotional, like all politics tend to be these days, it's very hard to maintain the discipline. You got any trick there, or any guidance to help people sort of maintain their equilibrium, if you will?
Well, I think that's where, hiring a good group of advisors like the folks at Private Vista come into play. I mean, where if you're an individual trying to manage your money, you probably let emotion get more to you versus, I think that's why you're, choosing to have an advisor help get you towards your financial goals, because ultimately they're not going to bring the emotion into it. I think it's, important to not get emotional about these things. And, but it's a lot harder said than done, because I think people, fall in love with stocks, they fall in love with fund managers, but, again, I think it's just making sure you have a plan in place and make sure you stick to that plan no matter sort of what the environment, what the emotional side of things are telling you. There is a strong behavioral bias within investing. And if you can recognize it, I think that's the first step is, making sure that to just understand where you are, take a deep breath, don't panic on things. Because typically, again, over really long periods of time, our lifetimes, markets tend to go up and to the right. And, it's not a whole lot on the horizon that, we can see that's really going to change that proposition.
Good advice. Good advice. And it sounds like a plug for Nicole, as a matter of fact.
I mean, I couldn't agree more.
Nicole, for those people who are listening who, maybe think maybe I could use some nice steady guidance from Nicole's hands and the folks at My Private Vista, how do they reach out to you and how do they get in touch?
Yeah, absolutely. So there's two ways. You can call us at 312-831-4370, and our receptionist can either connect you to me or any one of my fabulous colleagues, or you can go to our website, which the link will be in the show notes, but on our homepage, there's a contact us button and just put your information there. You can reference this podcast episode and either myself or again, one of my colleagues will reach out to have a conversation.
Great. And if anybody has any questions that they're curious about Jeremy's feedback on, should they just send them to you, Nicole? How should folks deal with that?
Yeah, that'll be best. So if you did have any follow-up questions or wanted to get some of the charts we mentioned, please just reach out to me. And again, you can do that through either calling our receptionist or our website, and then that'll get directed to me, and we can get you in contact with Jeremy or get the information to you.
That's great. The other thing you can do if you are listening to this podcast and you're not a subscriber is become a subscriber. And that part is really easy. It takes a nanosecond. Just hit the follow button. Then you will be notified every time Nicole drops a new episode of Dollars and Cents. You can give it a listen. And if you like it, tell people about it. Share it. Word of mouth promotion is very effective and most welcome. Until next time, I'm Bill Tucker, and on behalf of Nicole and everybody at My Private Vista, thank you so much for taking the time to listen today. And remember, you can go out today and make today a great day or not. The choice is yours. Until next time.
Thank you for listening to the Dollars and Cents, Creating Your Fulfilled Life with Nicole Romito, sponsored by Private Vista. Visit our website at www.myprivatevista.com or give us a call at 312-831-4370. And don't forget to click the follow button to be notified when new episodes become available. Private Vista is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is neither indicative nor a guarantee of future results. The investment opportunities referenced herein may not be suitable for all investors. All data or other information referenced herein is from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other data or information contained in this presentation is provided as general market commentary and does not constitute investment advice. Private Vista and Hightower Advisors, LLC, or any of its affiliates make no representations or warranties expressed or implied as to the accuracy or completeness of the information or for statements or errors or omissions, or results obtained from the use of this information. Private Vista and Hightower Advisors, LLC assume no liability for action made or taken in reliance on or relating in any way to this information. The information is provided as of the date referenced. Such data and other information are subject to changes without notice. This was created for informational purposes only. The opinions expressed herein are solely those of the authors and do not represent those of Hightower Advisors, LLC, or any of its affiliates.